class. Today we're going to be talking about the goods and services market, which is the first piece to the Keynesian model, or the ISLM model. So when we talked about the classical model at the beginning of class, the short-run production was solely driven by the supply side. But now, since both prices and wages are sticky in the short run, this short-run production is driven by the demand side, or what the consumer decides they want to consume. So we're going to be discussing the actual expenditure. Actual expenditure is different from the planned expenditure because the planned is what the firm recognizes beforehand that they're going to need. But the actual expenditure is both the planned and the unplanned inventory. So this is different because let's say we have a recession. Consumption would decrease, which in turn the total expenditure would decrease. Consumption decreases, expenditure will decrease. Then the inventories will accumulate and thus decrease in the production later on and decreasing employment because there's a stockpile of inventory that wasn't sold like they planned. So we're going to be really focusing on what the actual expenditure is. An expenditure for us is equal to consumption plus investment plus government spending. And it also can be called aggregate demand. So let's break this up into parts. The first part we're going to talk about is consumption. So before, our consumption equaled our disposable income. So C equals Y minus T. Consumption equals GDP/income minus your taxes. Now we need to take into consideration both autonomous consumption, which is the A right here. It's basically how much a person needs to consume even if they have zero income. So remember we talked about this when we were talking about the classical model, and I brought up Maslow's hierarchy of needs. A person needs food, shelter, and water even if they don't have any income. So this is autonomous consumption. Then we need to take into consideration the slope, or the marginal propensity to consume, MPC. And remember, marginal propensity to consume is a fraction. So it is less than 1, but greater than 0. So it's always positive and it's less than 1. Okay? So we could graph this out, which I have already done. Autonomous consumption, and then we have a slope. Our x-axis will be GDP/income. Remember, Y is GDP, and it also represents income. Then our y-axis is our expenditure, E. So I'm going to label this line 1 because it's the line that will be shifting or tilting in our examples. So, their consumption is a function of a lot of different parts, and all of these influence the consumption levels a person can have. So, disposable income. Let's say if taxes increase, what will happen to the expenditure levels? Let's go through and create relationships for each of these parts. So as taxes increase, expenditure will decrease. So this has an inverse relationship. As debt levels increase, consumption or expenditure will decrease. Because if someone is accumulating debt, they won't be able to spend and spend and spend because they'll be paying back that debt. If available credit increases, we'll have a positive relationship to the amount of consumption or directly expenditure that will happen. As interest rates increase, remember interest rates, real interest rates equals nominal interest rates minus inflation. So as real interest rates increase, well, expenditure will decrease. We don't want to deal with high interest rates. As consumer confidence increases, well, we'll be spending more. So remember when I talked about if the economy is doing really well, consumer confidence is blowing up, then people will be more likely to take the vacations, buy a new car. But if the economy is staggering and we're dipping into a recession, people would be less likely to do those things, and their consumer confidence would be low. So there's a direct relationship between consumer confidence and expenditure. And lastly, wealth. As wealth increases, we could see a positive relationship with expenditure because you have more to spend. So these relationships will be important when we go and start shifting and moving around this expenditure line. Okay, so the next piece in this expenditure function is the interest rates. Is the investment. Big I, investment. So what exactly is this investment? Well, it could be buildings or factories. It could be the financing equipment or paying off employees. It could be a bunch of things. You're investing in the company. You're investing in yourself. Okay? So just like consumption, we have a bunch of relationships. So investment is a function of real interest rates, expected profits, business taxes, capacity utilization, which just means, do firms run at full capacity or do they run at less? And then output. So we'll go through and do these relationships as well. As the interest rates increase, similar to consumption, we would have a negative relationship because people will be less likely to invest at higher interest rates. If expected profits skyrocket, well, that company's going to do great. They're going to want to invest in that company. So that's a positive relationship. I always use the example of fidget spinners. At first, that company really took off, but after its peak, it dropped so fast the fad was over. So did people want to invest in that? No, because the expected profits were low. If business taxes increase, well, businesses wouldn't want to invest in that, so that would be a negative relationship. If the capacity utilization increases, so if a firm can make more in its space, then people want to invest, and that'll be a positive relationship. And lastly, if expected output is to rise, then people would want to invest. So that's a positive relationship as well. Again, these relationships will be important, so make sure you have them ready for when you do your homework and eventually take the exam. Okay? And the last piece is government spending. So if government spending increases, it'll directly increase expenditure in the economy. But if government spending falls, it'll decrease the expenditure in the economy because they're just added together. Okay? So our actual expenditure will equal our GDP. So remember, income equals expenditure, GDP equals expenditure. Okay? So our equilibrium, which every good model has, is expenditure equals GDP / income, or Y. So as you can see, this model doesn't have an equilibrium written down yet. That's because we need to add what is called the Keynesian cross, which is a 45-degree line showing the equilibrium E equals Y. So this is just a 45-degree line, placing E equal to Y, and it will never move. When we start shifting this graph, only the expenditure line here will be tilting up or down. This Keynesian cross line will not be moving. So our equilibrium is at Y1 and E1. So when we do start shifting this equation around, it will end up tilting. Because remember, autonomous consumption is fixed. But for our class, to make graphs easier, as long as you note that autonomous consumption is fixed, you could just draw your line going up and down. Okay? But I will tilt it and shift it like that. So let's do a few examples. What happens if expenditure increases. So what happens if expenditure increases and income stays the same? So with income staying the same, we know that that's an increase in the marginal propensity to consume. And we write out E equals C plus I plus G. We know if there's an increase in expenditure, there will be an increase in the consumption line, or the expenditure line. So that will tilt upward to 2. There will be an increase in GDP and the increase in expenditure. Okay? Next example, let me just erase this real quick. What happens if government spending increases? What if G increases? Well, we know E equals C plus I plus G. If government spending increases, that will increase expenditure. So if expenditure increases, we're going to increase from 1 to 2, tilt the line upward, draw our equilibrium, Y2, E2. Okay, so as E increases, Y will increase as well. But this is known as the Keynesian multiplier because if you increase your spending, the output would increase more. So we'll talk about that. It's very similar, exactly the same as the deposit multiplier. So we'll talk about that in a few more slides or videos. Okay, now I want you guys to practice this. So in between these videos, take a few moments to try these 2 problems. And when we come back in the next video, I'll answer those questions. So what happens if the expected profits decrease, and then what happens if the stock market increases? So try these 2 problems out, and then we'll work on the answers together.